Welcome back. 120 points higher on the Nifty is what we have. Let's talk about the oil and gas space. Upstream, downstream, standalone refiners. Everything has been doing fantastically well. Big rallies. And, the price move is forcing people who've stayed on the sidelines to change their view, participate. Analysts are, double upgrading things from, 500 rupees to 800 plus, like we've seen in the case, I think, of BPCL today, this morning. It's... the price dictates the mood, the sentiment. But fundamentally, what has really changed? That's what we want to understand. And to help us do that, we have Mr. M.K. Surana, former chairman and managing director at HPCL. He's run as big an organization as one can think of. And we also have Probal, who's a top energy analyst at ICICI Securities. Gentlemen, great to have both of you here. Thank you very much for your time, Mr. Surana. If I can start by asking you, sir, maybe a little tongue-in-cheek, but... one of the things which people say about PSUs, the logic to give by PSUs is that, they were highly inefficient. They've all become very efficient. As someone who's headed an organization of scale, do you think it's a bit of an exaggeration or you think it's true?
So good morning, Prashant. Let's see the question in two parts. One thing is probably people are used to paint everybody in the same brush. So there were PSUs were inefficient. There were PSUs which were efficient. The same case in the private sector also. But somehow the perception was that the private sectors are more efficient than public sectors. But having been in public sector, having worked for almost 40 years for public sectors, and having seen the public sectors functioning, I don't think that was entirely true. There were a lot of skill set available within PSU. In fact, many of the good private sector companies in the space where PSUs are made by the people who are ex-PSUs only. Even
Absolutely.
Abroad, many of the multinationals are made by the people who are ex-HPCL, BPCL, IOC, OMCs. And therefore, as far as skill set concerned, that was never in doubt. PSU had been one of the best training grounds and the grooming grounds for the talents. One of the questions which used to be there was related to some processes, some procedures which used to hinder the decision-making process.
Yeah.
There is a change to that effect where there is more aggressiveness, there is more realization to the impact which decision create in the market. The people are more oriented to how their share prices move in the market, and market cap had been the performance parameter in the oil PSUs or the PSUs, which were not the case earlier. And the last part is after the listings have happened right from 92, HPCL was one of the first to get listed.
Yeah.
So over a period of time, substantial minority shareholders have come in, and so the demand of the stakeholders have also increased. That's one part of it. Yeah. And the second part is over a period, the PSUs have been more adept in accommodating the new processes, new procedures, new technologies, etc., etc. Yeah. And the management also, the newer generation as well as the older generation has become alike to like any other private sector. And I think this is a sum total of that which we are seeing as far as the efficiency is concerned.
Yeah.
But I still believe that people in PSU have been as efficient, as hardworking, as sincere, rather more loyal than in many cases than many of the private sectors. Not to say anything wrong about the private sector, they have their own skill sets.
No, absolutely.
Mr. Surana, nothing wrong in that. So it is only being perceived now, it is getting demonstrated and it is being received well. I will put it.
No, absolutely. It's a very beautifully put. And my question was not at all about the skill set. I mean, absolutely take your point on, which is about processes, etc. And that point that you made about incentives, right? Much more attuned to share price, market cap. I mean, that is such a powerful shift, mind shift change, which I think has happened. Just one more specific point, Mr. Yeah, that is come through.
Technical orientation otherwise.
Absolutely. Yeah. Mr. Surana, just one thing, specifically, so, it used to be that most refineries here in India could not process, dirty crude, right? Only a few in the private space could process that, like the Jamnagar one, etc. Has that changed across OMCs? And
yes,
so that's also a fundamental change? Yeah.
Yes, to some extent, yes. Because if you remember earlier, most of the PSU refineries did not have the bottom upgradation facilities, but as in between the margin started getting under pressure, the need for deriving the best values from the bottom of the barrel kept on increasing. And a lot of the companies have put in facilities to upgrade their bottoms to more value-added products and the distillate yields. Okay. And that has led to many of the capex which has been put in last 5-10 years And those are getting fructified now to get much better product yields. And incidentally, it is also coinciding with the good margins on diesel and petrol. And that is, so that is what is definitely added to the profitability of the PSUs. Added to that, the energy efficiency, because the fuel and loss factor, which remains one thing. When the energy efficiency comes, it has got twin impact. One is from the decarbonization part of the reducing the carbon footprints. At the same time, the economy of operation as well. And that is also added to the thing.
Got it. Let me get Probal in. Points taken, Mr. Surana. Probal, you heard Mr. Surana. To your mind, as an analyst, what are the top 2 or 3 reasons why we've seen such a big re-rating and why many believe that there are much more upsides?
So I think I hesitate to follow Mr. Surana, who explained the industry dynamics much more clearly than anybody else. But there are 3 reasons. One is that if you look at both oil and gas prices, the range at which they're operating right now, I think till about $85, $86 of crude until about $12 to $13 of LNG. It's a price band that the Indian consumer or consuming companies can actually work with in a very comfortable manner. As far as upstream is concerned, oil realizations anyways are capped at about $75, which is higher than what they've done in the last 8-9 years. So it doesn't matter much if crude goes to 80 or 85. And as far as OMCs are concerned, marketing margins, when the prices were last actually changed in a meaningful way, if you look at equivalent crude prices then, as long as crude remains below $85, you will continue to make reasonable marketing margins. Mr. Surana mentioned about the impact of the debottlenecking, the bottom upgradation, upgrades that have happened across the OMCs on the GRM capabilities of the OMCs, and the fact that that has coincided with a strong uptake in diesel, petrol, and ATF spreads, which, unlike in the Singapore benchmark, are actually about 65 to 68% of the product yield for Indian refiners. If you put that together, then both on the refining and marketing front, the prospects appear to be much more stable. Specifically for, let's say, a stock like HPCL, where refining capacities are also being expanded and they're also adding significant petrochemical capabilities. I think the earnings mix, visibility, and the scale of operations all actually is slated to, improve over the next 2 to 3 years. So there are tactical reasons which have led to an increase, plus there are structural reasons from a 2 to 3 year perspective that are both actually working in favor. Yes, there will be obviously dips depending on what kind of price cut is taken, whether before or after elections. Frankly, I don't want to get into that kind of prophesizing because that's meaningless. And we'll have to look at what the margins are as a residual number. But what I would like to highlight is that even if you build in some sub $10 GRMs and about 3.5 rupees of marketing margins, even on that kind of bear case earnings, the stocks are still trading at a 50-55% discount to what the Nifty PE multiple is at, if you look at a 1 year forward direction, specifically for HPCL. I think that is a very, very important metric, that once the overhang or the perception, which seems to be going away, that there's a reason PSUs deserve to be trading at a 60% discount to everybody else, that seems to be going away. And I think that is one important metric, that's driving at least the PSU oil space over the last 6 months.
And HPCL presumably is your top pick, as you highlighted, I think. Probal, so even if oil already is at about 83, Brent is at 83. So if it goes higher, say it goes to 90, you're saying there could be corrections, but the P re-rating story is here to stay in that sense. That the perception that they need to trade at a vast discount, that is gone now. So that comfort is there, support will be there.
Yeah, I wouldn't go so far as to say that that has gone, but I would say that, you can build in a reasonable discount for the fact that there is always going to be some regulatory interference. There are always more than just profitability as an objective, and rightly so for some of the oil and gas companies. But, if crude rises to $90, again, one will have to see what kind of mix happens between the GRMs and the marketing margins. See, one way to look at it is that what do you actually make up for every rupee per liter of retail margin loss, for example. HPCL today needs to make about $2.6 or so of incremental GRMs. What they are doing well in terms of expanding of Vizag capacity and then adding Rajasthan is that number will go down to $1.5, $1.6. So therefore, if crude rises and product prices also rise in the markets and GRMs therefore go well, even if you're not making that much money on marketing, your overall earnings may not get hurt. And I think that is a very significant change that is happening. So when we'll have to look at the balance rather than just look at an absolute crude level. Yes, if crude rises sentimentally, always one looks at marketing and says, it would probably create some bearish sentiments. But I think that looks to be changing, from a 2-3 year perspective.
No, got it. I mean, Mr. Surana, you're no longer running HPCL, and I'm not sure if you're investing. But if I were to ask you again, maybe an unfair question, what's the best company in this space from an investor point of view?
That will be incorrect for me to answer. But just 2 points I want to add to what Probal said. The oil marketing companies or the oil companies always have an intrinsic value, but there used to be a risk perception against the thing in terms of the global dynamics and the government intervention, etc. During last 2-3 years, during the Corona time or during the Russian war or during the Middle East crisis, the way the crude supply portion has been handled and the policy decision has been taken and unequivocal stands have been taken, that is probably given, and during the Corona time, the way the whole thing has been happened as far as supply chain is concerned, the risk perception on the total commodity of oil has changed. That's what I think. And the people are perceiving it to be more resilient industry than what they used to do earlier. That's one point. The second point is that as such, because the market is going up, the value creation opportunities are limiting, and so the some of the things which had the value but were not getting realized are getting realized now. That's the second thing. The third part which you asked, that which is better, it is incorrect for me to answer, but all the 3 companies have their own plus and minuses and have added strengths, especially depending on the capex which they have put in and the type of facility which the companies have put. And all 3 are integrating with petrochemicals and expanding the capacity and putting some facility to decarbonize and bottom. So I think there is a value. Depending on what capex and what is the timing of fructification of the capex, the value will get realized. And their HPCL is having an advantage because last 5 years capex which was being put, that is getting fructified now.
Absolutely. There's a great conversation and great points, Mr. Surana. Probal and Mr. Surana, thank you very much for joining us. It's a short conversation, but I hope we can have you back, Mr. Surana, for a more detailed chat, because this is a theme, I think, which has got legs to run, as both of you would agree. Thank you very much for being here on the program.